Ladies and gentlemen, it's Adrian Zunchik, CMT Charter Market Technician. Welcome to the sixth edition of our trading congress, of our free trading congress that we host every year on an annual basis for traders to become better, to get a little bit more confidence, to learn early about many different profitable strategies, investments, early gem picks. It's all actually kept to to keep away from all the trolls, from all the idiots, to help you basically learn from profitable traders, from the best guidance, that knows, that basically from all the people, all the experienced traders that know what it means to lose money, who know what it means to getting wrecked, who basically all of them know, what it means to be unprofitable. And because of those expensive lessons, they also learn how to actually shape it for the profitable gains and just succeeding in a space, right? So ultimately, we are here to get a little bit of the different opinions. We are here to help you get back on the feet after the recent corrections. And at the same time, if anybody wants to make it a full-time job out of trading or participating in this space, well, you're in the right space, because actually the Trading Congress, this virtual congress, virtual trade camp that we host every year on the annual basis, like I said, is actually on the day 3, and we are just getting started with today's guest, who's actually Alex Fazel of Swissborg, my true friend, my great speaker on so many different conferences, so many awards won, basically. So many awards won everywhere, man. Everywhere you go, there's always a crowd of people around you. Everywhere you go, there's this beautiful smile on your face, man. This beautiful outlook. If I had hair like yours, I would also do the thing on the top. However, it's different, And I'm really honored to welcome you to the show, Alex. How's it going? How do you feel?
Thanks so much, Adrian. Listen, this is an antenna so that I can try to see where the market is going. I'm trying to capture all the energies and wavelengths for the crowd out there.
Oh man, shit. Maybe that's why I keep losing money all the time. Jesus. It's not helpful.
You got the beard, bro. The beard can do the same thing.
Yeah, but it's dragging me down, man. It's dragging me down. It is what it is, man. Ladies and gentlemen, for everybody who's not familiar with Alex, for whatever reason, be it, Alex is the man behind the success of Swissborg, alongside his brother as well, because that's a joint type of a long-term mission that they're on, with so much experience, with so much kind of like I should say expertise in the Web 2, Web 3 world, and talking to many investors just from the position of not only investor himself, right? Also as the actual builder and the founder and the leader in the space. So we're gonna learn a little bit more from Alex today. And to start off, to kick it off, like, what's your journey? How it's happened for Alex Fazel to be on November 27th at 1 p.m. Polish time plus 3 hours to Dubai time on this day, this time of the year?
Yeah, absolutely, brother. So I'm very, very lucky to have fallen into this beautiful new world, this new industry, this new sector, and more importantly, new community. So it was my brother, who's the CEO of Swissborg, who told me, he called me in 2016 and essentially went completely bonkers over the phone. He's like, Alex, there's something called the smart contracts. It's going to transform the entire financial industry and everything's going to be on chain and we're going to have token economics, blah, blah, blah. And dude, he just literally, my mind was about to blow up. I couldn't understand a single word of what he was saying, but I've never seen him as enthused in my entire life, other than, when we're watching Dragon Ball or doing crazy stuff as kids. But he was so excited about what was happening. And he was actually working with Julius Baer, with Sequoia Capital. So he comes from a hedge fund background. He understands traditional finance. So he's already deep into that world and just really said that the world is going to change. And he talked about already back then, like treasury bills on chain. He talked about yield coming on chain, real world assets coming on chain. That's back in 2016. And he said that even big institutions like BlackRock would end up on chain, and which is happening in front of our eyes almost 8 years after we had that chat. So it's crazy, Adrian, how things come full circle and how I was just very blessed and grateful to have people like my brother and other people at Swissborg bring me into this crazy, cool world.
Oh man, so what's the journey? You say 2016, of course. The smart contracts were introduced. The entire Ethereum, like 2014, it goes back as early as that. The entirety of Bitcoin goes back to 31st of October 2008, right? Freshly after Lehman Brothers bank collapse, basically, of the entire mortgage fail and the over leveraging, basically, of the entire industry with the credits. And it's crazy, right? And here we are in 2024. Time flies so fast. BlackRock is here. Larry Fink talks about crypto as a flight to quality. Bitcoin is on the verge of breaking 100K for good, actually, right? Because we tagged it. We tagged it on the CME futures. However, there's this substantial resistance, not even in the charts, but it's in our minds, right? And people materialize their thoughts because of the effect in psychology known as thought priming, that we materialize our thoughts and they actually, what we think is what we act. And as a result, those self-fulfilling prophecies just work, and it all happens to justify our decisions, even though it doesn't make sense. And speaking of sense, of efficiency, of rational, of logic, how does the crypto compare to intelligent investing? Like, what's the intelligent investor supposed to do in crypto?
Yeah, that's a very good question. And I feel like there are two completely different personas, right, Adrian? I think you're talking about the whole great financial crisis, right? And I think the way it was built in the past is for two core reasons: for the rich to stay rich, and also for, yeah, stay rich. So either build their wealth slowly, but also for capital preservation. So that was the core reason. So the rich created a gap, obviously, from the people who that are the all haves versus the wannabes, right? And essentially, the way they did it was they set multiple barriers in front of us. Number one is you need capital to make capital, so you couldn't have access to any of these investment products unless you had a minimum net worth to back it up, to be an accredited investor, to get the intelligent investor status, and all these type of weird accolades, right? But then on top of that, to make it even more complicated, the second layer was we're going to make all the terminology as complex as possible, so that you feel like an idiot and you feel like, on top of you not only you don't have the net worth, but even if you have the net worth, you have to basically give those access for someone to manage it for you. So you see how the system was built, Adrian. It was really built for a particular type of person and also for a specific industry. But nowadays with crypto, we have something that's accessible to all. And that's the most important concept that we have with cryptos is now the masses like us, the people, the wannabes, or the people who want to have something in life can finally do that, by our own. And so I think the intelligent investor definition itself has changed a lot, where it used to be you're intelligent because you have money, but now it's open to everyone.
Oh man, I couldn't agree more, right? And for everybody who's thinking of intelligent investing, they probably come to mind about Benjamin Graham and his
Yes.
quote unquote student, right? Ultimately, Warren Buffett right now. And well, a lot of intelligent investing means basically, of course, trying to work on a rational side of the business, right? And trying to read the data, raw numbers, facts, and try not to argue them. At the same time, it shows, and well, I should say it's arguable to many crypto investors, right? Because they see that actually, in the world of intelligent investing, the actual good companies that are low in the valuation, because for instance, of the low well, the companies that are undervalued, are supposed to be the still the valuable ones that are supposed to give a lot of returns over the time, right? And we buy into those more undervalued rather than less undervalued. And at the same time, we keep seeing those meme coins flying, that are called all the different types of names. So what's the bridge? Like, is it possible at all to find an intelligent investing in crypto?
Yeah, so I'd love to share a slide because you mentioned something that is extremely, extremely important, Adrian, and that I think we really, really need to jump in because I'm going to discredit my title when I say intelligent investor, Adrian, because actually the intelligent investor is a stupid title, and I'll tell you why. Because it's exactly covering what you touched upon, and we'll jump the glossary here, but the way I define intelligent investor to me is first, we have to understand what the investor profile and mindset is like. And I see it on a spectrum, Adrian. And you should never be on completely any side of the spectrum. I believe that the actual intelligent investor could be reframed and be called the flexible investor. And the reason why I use this terminology, Adrian, it could be flexible, it could be the adjusted investor, someone who has adjustable skills, because intelligent, the value investor concept from Benjamin Graham that you're talking about, Adrian, no longer works. And the reason why I say it no longer works is because Warren Buffett, the greatest investor of all time, has had an absolute disastrous performance since the 21st century. He made a crap load of money, right, from the mid 50s all the way to the early 2000s. And after that, he just got completely wrecked by some basic S&P 500 indices, and he's underperforming most of these indices as well, or the funds. And why is that? It's not because he has a lack of intelligence, Adrian. It's because he has a lack of flexibility or adjustability, and therefore I'm correcting my own title, and I did that on purpose, almost like an oxymoron. If you're too intelligent, if you're too much on one side of the spectrum, you're actually stupid. Is my whole point here, Adrian. I don't know if that makes sense to you. If you have any comments on that before I jump
Oh,
into what I
that's
believe are the factors.
oh, that's man, and it's so well put through. Actually, I very much loved the, I love the the presentation in the background. What a cool way to visualize that. And what I'm thinking, of course, is me being a CMT holding this charter market ignition title. Is parallel to CFA. So CFA is more of a intelligent investing, right? Just like you mentioned it to the core, right? On the other hand, the CMT is much more of well, intelligent, but it's another kind of like a more behaviorally driven, type of investing, right? So what we try to do is we try to bring those different quantitative strategies wrapped around the human behavior, right? Because all we know is that those human behaviors, those herding instincts, is exactly what push people to the far far irrational behaviors, basically, right? Is the Bitcoin goes on and keeps going, and people only buy at the top, right? Most of the times, right? Because they feel encouraged and pressed the most by some other people, by their peers, by their friends, by their families, you know that's why we always pick up the phones, after some time when Bitcoin rallies. I actually had several discussions with a couple of people, that I truly respect outside of the space. They were actually from the Web 2, like deep Web 2. They didn't have much to do with crypto. And when Bitcoin was breaking $20,000 last year over 200-day moving average, which was flattened at that time, that represents the trend. The flatness at that time was just coming freshly off the bear market, but it's changed the regime, it's changed the direction, it stopped falling, and it's actually started building a base out of that. And there was this significant breakout for the first time that was, confirmed by the price action, by the volatility, by the momentum, by the breadth of the market. That it wasn't just Bitcoin. There was also a couple of other kind of like big awakenings happening. So it told me that there was this significant flow of capital basically positioning us in one direction and not another, right? And there were numbers to back it up. So it wasn't much of my guess. It was much actually what I saw in the charts. And I just gave those couple of those guys a notice saying, hey, there's something cooking behind the scenes. Like there's something abnormal. There's something that hadn't happened in over 2 years, for instance, right? And anything that happens every 2 years, basically by definition, is infrequent. And by that, we have to pay more attention to it than all the other noise happening in behind, in between. And most of those people, of course, ignored, that signal. And I'm like, sure. I mean, I've been there, I've done that. I know that typically people are risk averse. They are not really feeling comfortable with taking the risks on one hand, but it is on the other hand when the situation is extremely irrational, because it's just literally, cooking up so much of the bull peak, mania for buying frenzy. Everybody talks about it. Then this is, the far irrational choice that I'm actually make to enter in that space then, and not, so much earlier. So on one hand, it's of course understanding this valuation on the fundamental side, as in to knowing where the potential trend regime change shifts, on the long term basis. And at the same time, there are all those different behavioral factors, that just push us irrationally to extend those spirals, to extend those positive feedbacks, just amplify and multiply all those rallies to the upside, and multiply them also to the downside, right, on the south direction. So from my perspective, when there's a lot of decentralized kind of like an economy here, right? When there's no cash flows, but Bitcoin doesn't have cash flows per se, right? It doesn't have, you cannot run a discounted cash flow kind of like a type of an analysis, like a discounted cash flows DCF, type of evaluation. You cannot have the price to earnings. You cannot have the Cape Shiller type of indicators. You cannot have the price to book values, price to sales. Bitcoin doesn't have sales, yet it still performs, and it's still going, and it's going as a behavioral phenomena, as a social phenomena, right? As a paradigm, and it's still growing. So on that note, Bitcoin is a completely different, an opposite, extremely opposite to case study to what you would see typically in the intelligent investing by the Benjamin Graham and Warren Buffett. Isn't that right?
Yeah, 100%. I think you mentioned something that I really need to emphasize and capitalize on, Bird, because you're dropping some really important points. And that's kind of connected to the first spectrum. So these are the four categories that you could have more, by the way, guys, but these are very important to truly understand who you are as an investor. And I think, unfortunately, like Burb, due to social media and a lot of the junk that is disturbing our current lives, or that's taking us out of the track, we tend to lack the time for reflecting on truly who we are and who we want to be like. And so, what you said, I think, is the first component of risk return mindset. There is a concept which is called asymmetrical return assets. So, when you're talking about Bitcoin at $20,000, you're essentially weighing what are the probabilities that I am ROI positive. And if you have 51% positive and 49% negative, that's called asymmetry. And that asymmetrical return asset, the more you have, like if it's 20K and it's retraced from 64K, then that's a lot of asymmetrical returns. So it's really understanding that concept of asymmetrical mindset of risk versus returns. And by the way, Burb, this is not just something for investing. This is something for everything in life. Like if you see life through that dual lens, like the risk you're taking before a decision versus the return, your life will absolutely change. I'll give you guys an example, right? Like my daughter is 9 years young, and I try to really make her to think not just long term rather than just short term, but short term versus long term, but also risk versus rewards. And so, for instance, let's imagine she has to meet up with a friend, which is something we probably do every day, meet up with somebody. And she's like, oh, I want to change my dress before meeting my friend. And we're roughly 5 minutes away from being late. Then I ask her, is it really worth changing your dress knowing that you may be late for your friend? And if you're late, how will your friend feel? Oh, maybe they'll be disappointed or stressed or annoyed. Okay, great. So is it worth the risk to change your dress? I know it sounds crazy, Adrian. I know it sounds crazy, but I want to keep it to also daily life situations to truly understand how you make decisions. And just saying like, oh, I'm a conservative investor or I'm an aggressive investor, I'm a moderate investor is not enough. We need to connect that with the second spectrum, which is you could be very conservative, right? You're only holding gold and maybe some real estate or something like that. But if you put a very small percentage of your total net worth, you do not need to be conservative, right? I know people who are very conservative. They don't even hold Bitcoin, but they bought some meme coins for the fun of it. They just wanted a kick, right? They wanted that dopamine. They're like, listen, this is probably has more asymmetrical returns than buying a lottery ticket. So why not just throw some money in this random meme coin for fun, right? For entertainment. So once again, you don't really know who you are, whether you're conservative or aggressive, if you don't understand the percentage of your total net worth that's being put into that specific bet. And then the two others, Burb, I just want to finish this real quick, is really understanding what are your short-term goals. If you're short-term and you understand trading, you should definitely listen to Burb, the traders. I'm not a trader. I don't know how to trade. I suck at trading. So it's not for me. So I'm more of a
There's
long-term
two
guy.
of us then.
Yeah. I'm more of a I'm more of a passive investor who rebalances. So I like to set longer term goals and put less pressure on myself because trading has too much intensity for me as a person. I'm too emotional. And then the last one is, as we said, in terms of financial IQ, the intelligent investor title is a dumb title. You have to be flexible, in my humble opinion, once again, because you don't want to be Warren Buffett who missed on Bitcoin, which is the best ROI asset of all time.
Oh man, what a tag right there. Um, what I think, just on top of that, what I think is relevant is for many people, and also for what you mentioned too about your daughter. Give her a proper hug from me after the show as well. Is there risk adjusted returns? Is that what we call that, right? Basically, so it's not only the risk, it's not only the return, it's actually a combination of both factors and the ratio that you put one against another that makes it a deal to be positive or negative to be taken, right? So the way I see it, for instance, if we compare the profitability, in terms of the risk adjusted returns for traditional stocks, as in just like an index S&P 500 or Nasdaq, even, right? Nasdaq is going to be, of course, a little bit more aggressive on the upside, on the upside and on the risk. The ratio is going to be a little bit similar to S&P. For the risk, for the returns adjusted against the risk, what is going to give us basically is probably a ratio of I don't know, zero point 0.2, zero point 0.3, maybe, right? The typical average return, for annualized, S&P is going to be anywhere between 10, 9, maybe at times, depending on the year, 9, and the time frame, of course, anywhere between 9 and 10, 12, 13%, maybe best, right? This year was an exceptional candidate for 12.8% ever since 19. I think it was 49 as well, right? So the kind of like a big scope of data for the election years, where you would have two specific type of candidates, and the markets basically typically perform best when there's like a Democrat president and just Republican Congress. The mixture of both basically, is exactly what says the market to pump best, which is interesting on its own. However, Bitcoin is nowhere near those level. It's actually 10x on it's completely different number, right? Bitcoin, for instance, the annualized volatility of Bitcoin for per the 30-day standard deviation annualized basically is going to be anywhere right now per the block, around 55%, if I'm not mistaken. The return side so far already on a year-to-date basis is going to be anywhere between 120%, right? Maybe 110, 15%. It was 130% when it was back above 40, 50, 95k or so. So we are talking about 130 against 50, right? Almost 3x, almost 2.5x, 3x over, this is the adjusted return, right? So 3x against zero point 0.3, that's a 10x difference. So I fully agree that even though many people are not feeling comfortable, with taking big risks, as a matter of fact, from the traditional uh, institutional perspective, this is also why funds are getting interested in Bitcoin. This is also why central banks are getting interested. While all those countries and pension funds are actually want to expanding into Bitcoin and digital assets, aggressively, because just a small portion of risk, if they put in, allocate 1% of their reserves, right? 0.5% of their reserves, it boosts the return side so much more, right? Because there is tiny minimal capped risk. And the upside of that is 10x bigger than the one actually from the S&P 500 index, right? So knowing it, actually, because I don't want to, just, I don't want to go and steal the show, because I can go on and rumble for the entirety of the show. So I just shut up. Although the core principles, right, of value investing, like as we named, the price to earnings, all those types of things. So was it in for your lens? Like, how do you see the typical type of valuation, that you would just do in crypto?
Ooh, I love it. I have a slide for that as well. Okay, let me just go back. I was preparing some slides with regards to the influence and power of the Fed on our all-time highs. So I'll maybe skip that for now, and maybe I'll go straight into, you said market capitalization targets, right? Is that
For
correct?
instance, yeah.
Okay, so I'll just jump straight into that if you want me to comment on this. So and this is very important, Adrian. It's a very important question because in the previous slide, we were talking about knowing your goals. But how can you set goals when you don't know where we're going or how high we're going, right? So you can't. The answer is you cannot, because that's just guessing and it's not a smart goal. It's not necessarily measurable or realistic. And for us to truly understand how far we can go, I think past data is the best indicator of future performance. And we have lots of cycles to look at. And just for me, Adrian, and I know the Bitcoin maxis out there are not going to like this. I'm a crypto. I love altcoins, so please do not hate me for that. It's just that I feel like I understand that market very well, and I feel like I can make more money if you're active and you really get to know people. But if we have a look at this, this chart is a total crypto market capitalization. So for everyone watching here, this is Bitcoin, including every single asset out there. Okay. And we can look at the bubbles from the first bubble of 2014 all the way to the current bubble, which may last until 2025, if we're very lucky, 26, which I doubt. But we can maybe talk about market duration later, Burb. But essentially, what you guys can notice as a general trend is the multipliers are going down. We're not making as crazy money as we did in the previous cycles. However, on the good side, the drawdowns are also not as brutal over time. And so when we look at total crypto market capitalization, if we take from the second bubble, if you guys look at that bubble, 2018, we hit $775 billion, right? The following market, which was the 20 to 2021 market, we hit $3 trillion. So if you look at all-time high from all-time high across these two cycles, we have roughly a 4 to 5 times, right? Multiplier. Now, if we see relative to the first bubble and we're looking at where do we go in terms of the total value of all crypto assets by the end of the cycle, I think it would be safe to say, Adrian, that we can go from $3 trillion, it was 2.9 in the previous cycle, to somewhere between $6 to 9 trillion of total crypto market capitalization. And that's roughly a 2 to 3 multiplier, which is smaller than the previous altcoin cycle 2 to 3. If you look at this, right? So we went from a 4 to 5 times multiplier. This is probably a 2 to 3 times multiplier. As we said earlier, the upside is smaller, but also the correction and the downside, the drawdowns will also be not as brutal as before. So I would say, if, Adrian, we finish with Bitcoin as half of the value of the market, I think $3 trillion all the way up to $4.5 trillion target could be a healthy one. What do you think? And do you think I'm crazy?
I think you are right. I actually think you're right. I mean, my personal aim was anywhere closer to 10 trillion, right? Probably I would shoot a shot, for 40% Bitcoin, 60% altcoins, right? I mean, still because of the institutional inflow that, of course, just anchors to Bitcoin strongly, right? Because of the ETFs or the custody issues, right? And just meme coins, or well, meme coins, the altcoins and the meme coins, of course, are much more aggressive on the risk side, right? So much easier to lose them, get hacked in, which is of course the risk that is often unacceptable for those big mining people, because big mining people, in terms of the risk aversion curve, they don't need big money to, or they don't need big risks, right? On big money, the more money you have, the less risk you actually have to compensate for the same amount of money that you want to earn, right? Because of the percentage law and so on. So it just, when the zeros add up, I think we don't need so much risk anymore. So we're gonna naturally become much more risk conservative as we grow the wealth, uh, which is in a sense sort of like, well, maybe irrational from one point, right? Because some people say that, okay, I mean, it doesn't matter what money I'm playing, I'm still playing the same systems, the same rules as in 2%, risk account, but per account, per trade, and regardless if I do have 5 zeros on the account or 25 zeros, it doesn't matter. Well, on one hand, yes, on another hand is just, that how it works, that the that the absolute risk, basically taken as the money capital at risk, the value at risk is actually big, right? When we adapt those zeros. So to my perspective, I think that Bitcoin is going to be the main institutional asset, maybe Ethereum as well, of course, right? And a couple of the other ETFs. Still, it probably, safe to assume like 80-20 Pareto rule there, that Bitcoin is going to compensate for 80% of the institutional interest. However, the retails haven't even woken up yet, right? And the retails are exactly who pump the markets to the extremes. The people who buy it like there's no tomorrow because of the scarcity or those perceived scarcity, even though its assets are very often inflationary. This is something that just makes those rallies crazy. So I wouldn't be surprised if the altcoin market just continues to exceed the Bitcoin market capitalization at one point. For the date, 2026 is a perfect bear market candidate, like 2024, 2022, like 2018, 2014, 20 and 10. And the story is all this time, right, as they say. And if the numbers work this way, and this is a bear market, typical stock market pre-election, stock market election cycle, for your election cycle, points as the midterm bear markets as a typical go-to solution, right? So the such as the pre-election years, for instance, have historically, like the last year was when Bitcoin pumped 160%. It was 95% or 97% probable over the last 70, 80 years, ever since 1939, for Bitcoin and for traditional assets, and for the strong correlation means with Bitcoin and Bitcoin as well, to be profitable, to close higher than an open, to be bullish, to be a bull market kickoff. That's where it was. 2026, just like 2022, and every 4 years approximately, that the halving cycle just coincides, lines up to be the bear market, right? So if it's a bear market, maybe it's going to start January, maybe it's going to start end of 2025. Me privately, I'm starting the upfront process in the second half of the next year, basically, right? I'm going to give myself a margin and buffer of a couple of months to just have time to run, and it's going to take time. So same time scope, same similar targets. uh, I wish I could disagree on something to make it even more entertaining for the discussion, but there's nothing. I mean, we're on the same page so far.
And I agree also with the potential $10 trillion market cap. There's actually a fund in New York, which is one of the biggest crypto funds, is called 10T for $10 trillion, because that's what they think could be. And the reason why I chose 6 to 9 is because I just want to play a little bit safe. Swissborg is an exchange. We don't want to give like too aggressive projections. So yeah, if you're conservative guys out there, once we hit $6 trillion, start thinking about taking profits. For those who are a little more comfortable with the risk, like Adrian, he's been in this game for a very long time, so he's probably has more depth in terms of the way he manages his risk. But I think your projections, when it's sad to say, I don't have many things to disagree with you on, but I do have a few charts if you want to look at the average bull cycle duration, because I think, Adrian, as you said, we need to understand how high we will go, but also how long we will go. And once you can combine those two signals, not just signal one, I think it's very important for everyone out there. If you want a proper, flexible investor strategy, you have to have a short list of multiple signals. And once the signal one ties into signal two, or if you see multiple of your signals, multiple signals that are actually being coordinated, then that's when you know that your bias, or you should be taking out profits, or you should be executing the strategy that you, or goals that you had initially planned. But yeah, so just to follow up on your point, there's one thing that I love to say, and this is a bit corny and cheesy, Adrian, so sorry if it does come across as corny. But as you guys know, the financial cycles are 4 years. And the reason why it's 4 years, not just for Bitcoin, but actual traditional financial cycles, is because that's how the Fed creates their agenda, right? Their agenda is on a 4-year cycle, because it's not too far so that it's hard to predict, and it's not too short where they have time to adjust interest rates and potential easing. So the 4-year cycle is not just Bitcoin, it's usually a traditional financial cycle. And rather than thinking about all the complicated terms, I like to call these terms, the first one, here, instead of accumulation, you guys can call it spring. Instead of, the markup stages, you call it summer. Instead of the distribution stages, you call it fall or autumn, depending on whether you're British or American. And then the last one, markdown stages, which is winter. And I like this for the simple reason is it gives you a clear call to action. So during spring, you have to plant the seeds, right? During the markup stages, maybe you DCA, maybe you take some profits, you water those plants. During fall, you take all your profits, right? You harvest the crop. And then by winter, you enjoy a very, very nice meal with a proper potage, as we say in France. We cook those hard-earned harvesting and crops and vegetables. So, yeah, I don't know what you think about Burb. It's a bit cheesy, but what do you think about this as a analogy?
Man, I love it. I love it. I used to, funnily enough, my French used to be good. I used to be very good at French. and then I started doing all the engineering and finance, and I lost my French. So poutage sounds French, and I really have special love in my heart for all the French people. That's for sure. And what I'm thinking is, on top of it, is that just like you mentioned, on one hand, we have those patterns in terms of those fixed formulas coming from those who are behind the steering wheel. So there's this presidential cycle, just like you mentioned, the Fed cycle, right? On the liquidity boost, they put in the liquidity, take off the liquidity, as well. And of course, as they kind of like pump the interest rates, they reduce the liquidity in the market hedge, which is why there's so much less support and the price action so much more difficult on the institutional commercial side to take out the loans and just empower the economy, which is why economy just kind of like stalls often. And I think on top of it, there is uh, crucial point I think to many people is understanding that it's the financial cycle that leads the economic cycle and not the other way around, right? It's whatever happens in the finance with a
Yes.
laggard effect, 6 to 9 months
Yes.
on average by model, is going to find its own impact on the economy. If the bear market kicks in, well, it takes 6 to 9 months basically before people have realized how much they have lost. And people have already stopped distributing their capital and stopped spending on goods and service and basically empowering the economy, which is why economy as a fact in fact in turn starts either contracting or just stalling, right? So and it's when it's the other way around, when the people start making money on markets because of holding to assets basically that appreciate in value. Well, they have earnings, they have profits, they can spend those profits and money basically that they have on goods and services, empowering the economy in turn, right? So there's a financial cycle and the economic cycle, and many people say, okay, I mean, this cannot be a bull market because the economy is stalling. Well,
Yeah.
that's different, right? Bull market, bear market is a financial term, not the economic term. You know what I mean?
Let, let me do a quick mic drop for you. Whoop! There you go. And the reason why I have that mic drop, Adrian, is you hit the nail on the head, and that's it. That's the biggest misconception in the world. Some of the biggest pumps in terms of financial markets were during World War II in that generation. So why is it like that? Is exactly what you're saying, Adrian. People invest based on their visibility and their sentiment on the future of the markets, right? Finance is always one head, it's always one curve ahead of economic cycles. So that's absolutely key for everyone to understand. And the trigger, the catalyst of all this is the Fed, the American Fed in particular. Why? Because it's the biggest financial market in the world and it has a direct influence on all the other markets in the world. And I think that's really one important point to jump into, Adrian, because there's a lot of fake news going on the socials with people. Hey guys, what if it's the end of this cycle? These morons saying we have 1 month left, and all these idiots who have absolutely no understanding. And I'm sorry to get emotional and call them idiots, but they are idiots. And the reason why I get frustrated is because it makes some people make dumb decisions. And you said that earlier, right, Adrian? You said we need to filter from all the noise and all the BS, right, that we see on X by a lot of newbies who have no clue what they're doing. Now, just for everyone to understand, this is the true catalyst of the super cycle. It's in two components, right? It's global liquidity. There's nothing that matters more than global liquidity, and there are indices for that, indexes, and crypto liquidity. Why? Because the money flows into the markets and it's not in cash, it's not being in bond markets, it's not in gold, it's flowing into financial markets. And the way it does that is simply when the Fed lowers interest rates, right? Why? Because when they lower interest rates, that encourages borrowing and investing by making loans cheaper. But then number two, the Fed also increases the money supply, right? Quantitative easing, they inject liquidity into the markets, the money supply, and they start buying back debt and stimulating growth. Now, one thing that's really important is okay, that's great for stocks, but how does that go into the crypto markets? And I think it's current liquidity, which is retail and institutional, right? We have to differentiate the two, as you mentioned earlier, Adrian, very eloquently. But we also need new liquidity, which will come hopefully based on tech innovation, based on understanding of Bitcoin, just crossing the chasm, but also asset class bubbles. It's very important that we create bubbles because that creates hype, even though they're often short lived, but will still end up creating innovative technology. We really need to understand that we need A plus B. And just to go a little bit further on why this is definitely not the end of the cycle, is let's look at the actual statistics behind this hypothesis. So, number one, we got to understand, if you guys look at the bottom left corner, you see that little white chart. This is the Fed and interest rates, right? So essentially, you can see that every single cycle that we've had in the past is when interest rates are below 2%. What is the current interest rate? It's 4.75%. So we're not even half there in terms of the interest rates lowering. And as you guys may know, I'll jump straight into the third bullet point, which what Jerome Powell said in the last FOMC is that his goal is to hit 2% by next year. So there's no way in the world that this is the end of the cycle. So don't listen to these morons. It's really toxic. And then number two, one thing that's really important is the Fed can create this super cycle, will trigger the super cycle. They already have with the interest rates slightly lowering more optimistically than we thought with 50 basis points, etc. But they can also kill the market. That's one part that's really important, Adrian. And what we can see in the second bullet essentially is every time investors feel like interest rates are going to go up, that's when the market crashes, right? And that's when they start parking their money into cash, into T-bills, into different products, and will leave the crypto markets, unfortunately. And that's when we'll get a drawdown. So I don't know, Burb, I've been very emotionally aggressive on this. It's just because I want to stress your point on all the idiots out there who are sending like misinformation and making people panic. What do you think? Am I too harsh?
Well, I would only say that it's passion, it's passion. It's for a good reason. And of course, it's hard to disagree with that, right? I think that at times it's people, behind the steering wheels that are not necessarily competent enough to just play the role, and they are still there in many different shapes and fashion. I think it's global issue, right? Of choosing the elites, or actually the elites choosing themselves instead of listening to the Vox Populi, right? But that's another problem. And as we kind of like get closer to the wrap of the show, Alex, I've got two questions to you, right? Because 2025 is right ahead. It's just right around the corner. With January 1st, 2025, not only the MiCA regulations are coming in Europe, and there's going to be a proper entire session soon after regarding the MiCA regulations that I encourage everybody to go ahead and stay tuned for that, because it's going to be super interesting, because it's basically going to just trim and probably flip upside down the entire industry in the Europe, and truthfully in the entire world, because it's going to be subject to that is going to be anybody who's from the European Union, and at the same time who's outside from the European Union targeting the European Union. So it's going to be so much interesting. However, one point and a question to you, right? Because there's this Basel committee for the type of a supervisory recommendations for the central banks globally, and 2022, the bottom of the bear market, they actually made first recommendation. They made a couple of trims and changes for instructions for the central banks on how to quantify the risks on digital assets, on Bitcoin, on utility tokens, on stable coins, uh, and it's just around the corner. So my question to you, Alex, is what's gonna change for the banks to hold the percentage of their reserves in crypto assets? What's the result from your perspective, briefly?
Yeah, absolutely. One of the most interesting sectors for me is going to be the DeFi bubble. We're going to have another DeFi bubble. DeFi Summer 2.0 is going to come back, and it's going to come back even bigger because the DeFi bubble from 2020, 2021, you remember, Adrian, the good old like 50% yield on your USDC. Some people are offering quadruple digit yields, which was nuts. That's going to come back. And simply because you have projects like Morpho that are offering institutional players to be able to adjust the risk parameters so that the institutions can comply with local authorities and then deploy on chain. So if they want to deploy those chains, then that's going to bring a huge amount of capital. And when all that TVL is going to come back to DeFi, and we're going to completely going to blow up the previous all-time highs. We're already close because we have liquid staking, we have restaking, lots of new forming bubbles that are coming on chain, plus this institutional offering. I think we're going to get huge DeFi APY again. And that's going to trigger a massive bull run in the DeFi sector. And I'm very proud to say, Burb, is Swissborg was the first exchange in the world to offer DeFi yield for the masses. And we're going to be also MiCA compliant, I believe. We've already documented and submitted that. So for those who want to really enjoy, we're already offering 13% on USDC. We're offering 12% on Sol with very, very low risk. We haven't lost a single dollar since we launched our app in 2019. So I think one thing that really people should look at and start getting interested in is really look at the DeFi sector, look at the DEXs that have maybe overcorrected, look at the liquid staking, restaking protocols that probably are already pumping, like as of today. It's a sector that's kicking off again. But I think there's going to be huge opportunities, Adrian, in terms of token price action, but also staking and lending.
I love it, Alex. I love it. I love it so much. And you've actually, well, accidentally answered the second question that I had about Swissborg. So I couldn't actually resist, but just give a proper shout out to you, Alex, and to your brother, to everybody who's behind the Swissborg. I mean, we are friends. I'm familiar with the brand. I'm a big fan of what you guys are doing in terms of bringing in the masses, just bringing this, like I said, this utility to, you know, to the masses. I mean, as simple as that, right? For the people want simplicity. They want to have the understanding. They want to feel appreciated. They want to feel, that they are the actual, you know, that they're the opportunity takers, right? They are not a project. They're not a product. They are not a subject. They are not kind of like a small piece. They are actually the people that we do the work for, right? And that seems to be the main dominant tendency in Swiss work. So a huge shout out and appreciation goes to you, Alex, and to your entire team. Beautiful people. And I can not recommend enough so that you guys get ahead and just hit the follow button on the Twitter accounts, on the X account at Swissborg. Basically, as simple as that. And that's a kind of recommendation from me. And I think Alex is also gonna take a lot of well deserved credit for the hard work and for all the outcomes and fruits from Swissborg. And is there anything else, the final message, the final takeaway that you'd love to leave our viewers and listeners with for today, Alex?
Yeah, absolutely, buddy. I mean, since we're talking about the intelligent investor, I would love to throw just a summary for everyone so that they can really make this actionable for them and create healthy habits for the current cycle. But for those who just tuned in and maybe missed the earlier talks, please revisit it again. But once again, it's number one, understanding yourself before understanding anything else is probably the most important part of the investor journey, whether you're an investor or trader. So ask yourself really this, like, who am I as an investor? What is my risk tolerance? What are my goals? What is my IQ? Am I flexible enough? The second point is think about the bull run cycle duration. You don't need to understand the full 4 years, just understand how the summer, so the markup stages work. So it could be as fast as maybe it could end in 4 to 7 months if we're very lucky, and that because we have more liquidity coming from the institutional side, maybe at the latest by the end of next year, as Adrian was saying. But yeah, be ready to take profits and duration. I would say anywhere from April to end of the year, 2025. And then another signal that's very important for you as an investor is remember total crypto market capitalization. I would aim between $6 trillion to $9 trillion, which is very important. And then if you guys have a higher risk tolerance and you're okay with altcoins, I think Bitcoin tends to top at 20%, 60% dominance, and use tends to drop all the way down to like 35 to 40% dominance. So while the Bitcoin dominance is dropping and altcoins are mooning, if you want to take that risk, take it. I'm personally going to take it, but don't forget to come back. So once the altcoin dominance or Bitcoin dominance drops to, let's say, 35%, 40%, and it starts climbing back up, remember that means that the general investor's risk tolerance is disappearing. And for those reasons, you need to climb back up. So either go back into Bitcoin, either buy real estate, buy a house for your family, buy yourself a car, whatever, guilty pleasure you have out there. In Dubai, people like the limited watches and stuff like that, the bling. Not my personal cup of tea, but it's very important that you understand these things and combine the signals so that you're ready to reap the fruits of this beautiful super cycle.
Thank you. And speaking of the comebacks, I cannot wait for you to come back to the shows anytime soon, Alex. It's been such an incredible feast of the intelligence in investing. And as we wrap, everybody, actually, like I said, we want to extend the special appreciation, special shout outs, to our incredible speaker, to Alex Fazel of Swissborg. And also to also give a proper shout out to our incredible partners and sponsors at DYDX, Bybit, Cointel and Dragonslide who actually participate in our free trading congress, in the 6th edition of the Trading Congress 2024, and join us for the Discord, actually, with the giveaway that is going to come back right in the screen in a moment. And also, we are actually hosting those sessions, those special closed workshops inside of our Discord. And there's not a single piece of charge you're going to be asked to pay. It's zero. It costs zero, free, null, nothing, zilch, whatever you name that. You don't pay anything. Take as much knowledge as you can. We are celebrating as we get closer to the 7th anniversary of the Bourbonist for the existence. So we're going to kick off the 8th year of the action. So go ahead, join us on the Discord. Just scan the QR code that you see on the screens right now, as we are literally giving away the free monthly VIP subscriptions for after the show's end, for everybody to stay in and enjoy. And the slogan, the main theme of the entire Congress is that the best time is now. The best time to get interested in the space is now. The best time to get exposed in the space is now. The best time to get engaged with the right people, such as our today's guest, is now. So the best time is now, everybody. Alex Fazel has been our guest. Thank you so much for your courtesy and generosity, Alex, for coming. My man, love you, brother.
Love you, brother. Thanks so much, guys, for watching.
Thank you. See everybody on the next shows. God bless. Bye-bye.